Good afternoon, everybody. My name is Gary Johnson. I've been a friend of the firm for years now, and Mark Rylance and John Theriault have asked me to moderate this webinar so that they can focus in on answering your questions. So thanks, John and Mark, for including me on this very important webinar. This webinar is going to be question and answer. And these are the questions that clients are concerned about that Mark and John wanted to address with everybody in this forum. And when we were looking at these questions, there were certain themes that were coming up. So Mark, can you talk about those themes?
Sure. So I wrote a couple down. Let me share my screen here real quick.
Okay.
And let me see if I can do this. Okay. Okay, so these are the main themes. These aren't going to surprise anybody. Obviously, the global pandemic, how's that going to affect? I mean, let's face it, we're here to talk about stock prices, bond prices, investments for clients, and how it's going to affect everybody. So we'll talk a little bit about the pandemic. Obviously, we don't know how that's going to turn out, but we can address how it's affecting things financially and economically. We're getting a lot of calls, a lot of discussions about inflation. Is there going to be inflation next year? Is there going to be inflation in the future? I think there's also another side to that coin, which is deflation. And so we'll address that and take some questions on that. There's also the uncertainty about the future of growth. The U.S. economy, we are obviously in a major transition period. There's a lot going on socially, politically, and economically, so we'll address that. Future investment returns. How are stocks going to be affected by this long-term and short-term? What about bond prices, real estate, those sorts of things? Obviously, we'll touch on the election because that's 4 months away. And, probably the biggest question other than inflation is the disconnect of stock prices versus what's going on in the economy. I can't tell you how many times I've heard, at least 25 times, I don't get it. What's going on? It seems like it's disconnected. And unfortunately, I go back and I say, I don't get it either. But we'll address what I think's going on and kind of go from there. Okay?
Okay.
So I'm going to hand it over to Gary now, and you can start shooting off some questions.
All right. So I've got my first question is off of that last point that you made is how is it the market continues to rise given such challenging economic conditions?
You want me to take that, Gary?
Mark.
Okay. The answer is I don't know. No. No. So, well, I mean, I think what is happening is, when this pandemic originally came out, no one knew what it was, how it was going to affect people, how many people were going to die, what was going to be the economic impact. And so that's obviously, and it was, people were really scared. So that's why we had the precipitous drop, the historic drop in stock prices, down 35% on the S&P 500. But what's happened since then is a lot of the uncertainty is, it's been lifted. We know who it's affecting. We know that there's a ton of vaccines in the works. We know which industries are affected. We know how many people have been unemployed, laid off so far. So as uncertainty gets lifted, stock prices adjust. Stock market doesn't like uncertainty. But the big real disconnect is, okay, so we have unemployment. We still have 20 million plus people unemployed. Earnings are tanking, bankruptcies are occurring. So why is the stock market at the exact same point before this happened? Exactly. Now, granted, we'll talk, not all stocks are at the same point, but let's just call the S&P 500. So that's the disconnect. And I think really what has changed other than the removing of the uncertainty is the government has, I've said this in writings, they did if you could tie like 10 bazookas together and shoot it off, that's what they've done from a monetary stimulus standpoint. There's PPP loans to help people cover, their payroll. There's SBA loans that people can go get 3% loan. There's, disaster loans. There's loans to the airlines, the cruises, so on and so forth. The amount of stimulus is unprecedented. And so basically, I truly think the Federal Reserve and Congress diverted a depression, actually. And so there's going to be some effects long-term, obviously, with all the debt. But I think it really has to do with the amount of liquidity. Because if you give a bunch of investors a bunch of money to do whatever they want with, they're going to take risk. And so another thing that I think is affecting things is the 10-year treasury is 0.6% right now. And if you put like $1 million in a 10-year treasury, 10 years from now, will have made like $60,000. And so that's not incentive enough for anybody to want to lock up their money unless they are terrified of the future. And so I think what people are doing is they're looking at stocks thinking, yeah, they're as overvalued as they are, it's way better than buying a 10-year treasury. So the combination of those two is leading to where we are right now. And then from here, I think it's really going to be all related on the COVID, how it plays out, and then the twists and turns of the election in the next couple of months.
Got it. John, this next question is for you. As the economy recovers, what changes will you consider for the portfolio?
Well, there's a timing aspect to that when we talk about as the economy recovers. The question I get fairly often, it kind of goes back to what Mark was just talking about, is, how's the stock market taking off, but the economy is in this malaise and we don't see our way out of it. It's impossible for either Mark or I or any other investment professional to diagnose exactly when we can expect the economy to recover. You and I actually have talked about this in the past. I think it's distinctly tied to global health confidence. And if and when we're able to achieve that, hopefully sooner than later, the economic recovery will actually impact a variety of different things. But one of the areas that I think we're going to be looking at, obviously, and we're going to probably touch on this in more detail downstream, is how inevitably inflationary pressures will impact the investment portfolio. So with an economic recovery, if it's either quick and robust or if it's gradual and over time, we'll be looking at how that's going to impact inflationary pressure, how it's going to impact interest rates. We've recently made some changes to our fixed income portfolio. We'll talk about rates today in more detail. But there's also various areas of the stock market that have outperformed here during the recent sell-off and since, mostly large cap US growth companies. But there's also, by comparison, a lot of by comparison, are undervalued public companies, either international companies or certainly value stocks, where we have a presence. So we would anticipate that those portions of our portfolio would start to perform if money starts to rotate during the recovery, for sure.
So Mark, what concerns are you looking at during the second half of the year?
Well, the concerns are, I think the biggest concern is the prices of assets. And if this second wave, if that's what we're experiencing right now, gets worse, and then there's more layoffs or companies struggle even more than they are right now, I think eventually, there could be a reality that sets in where they're saying, this is bad. This is worse than we expected. Now, the flip side of that could definitely occur where it's not as bad. And, and then obviously coming into the November election, I mean, it is a pretty polarizing election, and they have much different policies. And so, if we'll cover the election a little bit later, but if Biden wins, there could be some dramatic changes from the current administration, and that would certainly, I think it would shock the markets, but will it change them long term? I'm not so sure about that. Yeah.
So John, do you think we will see inflation in the next 12 months?
In the next 12 months, I personally think inflation is unlikely. Now let's go back to the condition of the economy, the rate of unemployment, and maybe even, the caution that employers, both large and small, are going to exercise in bringing employees back. I think that consumer spending is down. When we take a look at what drives inflation, the amount of stimulus that is being pumped into the economy is probably a necessary thing. But a lot of that money hasn't been spent yet. And so when we look at inflation, we really look at events that will create a velocity on the movement of money. And I think that 12 months is probably, it seems like a long time. That's a year from now. But if I had to guess, I think that we would probably be looking out to the latter part of 2021, if not even into 2022, before we would see any inflation of major significance. You might see it in spots or segments, but I don't think, generally speaking, that rapid rise is imminent. I think one of the things we talk about is the government would actually like to see some inflation. If we're protecting against anything right now, it's deflation. Deflation. We already have a slowdown in consumer spending. Deflation would imply that what you buy today is going to be worth something less than tomorrow, and that's a much bigger systemic problem to get out of. So I think that we're probably kind of stuck in a relatively low growth, relatively low interest, and relatively low inflation environment until we can get through certainly the pandemic at a minimum.
So speaking of interest rates, Mark, with interest rates so low, how will you look to generate income for clients going forward?
That's a key question. Before I answer it, Gary, I'd like to go back to the inflation deflation thing.
Yeah, absolutely.
Just real quick, because everybody assumes there's going to be inflation, and and some think there's going to be massive inflation in the future just because of the amount of debt, the amount of available money in the system that is typically inflationary. There is a competing thought, though, that we need to be aware of. And there's some academics that real smart people, I can't remember if they're from Harvard or one of the Ivy Leagues, that they've written extensively with significant research that says the more debt you have, the less inflation you have, the slower you will grow. And typically I think they say once your debt to GDP ratio reaches over 100%, you can't grow regardless of how much stimulus you put. You can temporarily. Now, I don't know if that's true, but that is a competing theory. And but I do think the economy is going to recover. But I think inflation is I think it's well off, personally. Yeah. But then again, inflation. Who knows what inflation is? They say we don't eat or use gas in the inflation factor. They back that out. So who really truly knows what inflation is?
Yeah.
Yeah.
Yeah. So then on to the next question of the interest rates being so low. How will you look to generate income for your clients moving forward?
So we just had a long, our long investment committee meeting last week, and income it's on the top of my mind. It worries me because over the last 10 plus years, our Federal Reserve actions and monetary policy has driven interest rates lower and lower and lower. And who that penalizes is the savers, the retirees. Again, the 10-year treasury, you get 0.6. Back in the 80s, you'd get 15%. On the flip side, the low interest rates help the debtors, the people that don't have assets, that borrow money, and so it's a conundrum. So I do think back to the interest rate where you get income. I think we are starting to look at some other source of income where you need to take a look at things, dividend stocks, preferred stocks. There's REITs that's specialized REITs. It's for specific sectors of the real estate market. Obviously you probably don't want to buy retail or shopping mall real estate companies right now. But I think we're taking a hard look at that because in the next 10 years, if your bond side of your investments, which is half of people's portfolio for some, is earning 1 or 2%, that's not going to get it done. And so we are definitely looking at, but you can get to the extreme where you're reaching for yield, buying junk bonds and buying things that are high risk that people don't realize the true risk they are. High yield or junk bonds were down 35% in this last, or 30% in this last downturn. So it's a balance you have to weigh. But it's a very good question.
And if I can,
I also did there is a question I want to cover. We're having some chat themes coming in. So what is the best short-term investment for new money now, between now and the November election? I think I truly think if it's real short-term money, it doesn't pay to go long-term bonds right now. So I think it's either in a short-term, really safe money market or really short-term treasury. I think it's principal protection at this point and not stretching for yield, because again, with the COVID virus and the election, anything could happen.
What are you going to say, John?
No, I just, Mark touched on something, and it's something I've talked to a lot of clients about recently is we could be in store for a relatively low return environment, as we were just talking about, with rates as low as they are, and for the foreseeable future, they should remain low. I've had some client questions about bonds and fixed income. We'll talk about that later too. But one of the things that we do proactively, in addition to just trying to find the best placement, the best allocation for the investments, is we are incorporating these assumptions into more conservative financial planning for our clients. So we're giving them as realistic of a perspective as we can, that, at one point with a different interest rate environment, different environment altogether, we may have used different assumptions during retirement planning. Now we all agree as a firm that we want to be as conservative as possible, both with investment return projections, not forever, but certainly in the near term. So we're incorporating these assumptions into how we plan for our clients as well. I just wanted to add that.
So next question for you, John, is, are there any buying opportunities that look attractive in the current economy?
Well, cash and bonds are not doing too much for us. When we look at the equity sector, this may be redundant to my last response. We have an emphasis in value stocks and in smaller mid-cap stocks that have underperformed large cap growth here of late. We've had a lot of conversations with clients about that. But during periods of economic recovery, history would suggest we want to be there. Those are due for a rotation. We anticipate there could be some profit taking out of large cap growth a little bit later in the year. Certainly, we'll talk about that a little bit when we cover the election. But value stocks in our small and mid cap positions, we think would be poised to do quite well during a period of recovery. And then we also look at emerging markets, which is one of the more volatile equity positions. A lot of different countries are really struggling with the pandemic, and it's hard to gauge, again, based on the duration of how long the pandemic continues to not have a vaccine or a cure to be able to turn things in the other direction. But if we truly look downstream and future, we think that certainly emerging markets provides probably the most exciting growth opportunities for the equity side of the portfolio.
Mark, what sectors do you feel will benefit over the next 12 months?
That's a good question. It really depends on all the factors that I said that played out. I mean, I think what's going to happen is we will probably see continued strength on growth companies, technology companies, the stay-at-home stocks, even though they're starting to pull back or soften a bit right now. I think that will occur, but I do think a little bit longer term, I saw it described yesterday as not the stay-at-home stocks, but the go outside stocks or go out stocks, will probably, again, this is if we don't see significant, closures in the economy due to COVID in the winter. So that could be everything from consumer stocks to, it could be airline stocks, cruise stocks, industrial stocks. Typically, when you are leading out into the next push, when the economy is expanding, you will see banking stocks do very well. You will see someone I read describes it as banks and tanks, or the ones that you really want to see lead out. That typically means that you're now starting to expand into a more growthy type, to maybe the next stage of growth in the stock market. So again, it's going to be your boring stuff, industrials, consumer manufacturing, those economically sensitive sectors that got killed.
So let's talk. You guys had kind of touched on the election a little bit, but let's talk about that. Because that's coming up fast and furious. Is going to be here. As soon as we blink our eyes. John, how will the upcoming election affect the stock market, in your opinion?
My opinion.
Yeah.
I think that as with many elections, this one in particular, it stands to reason that there's going to be a lot of disruption, a lot of headlines. I think it's going to be a highly contested election. Remove polling data from today, I expect it could be a relatively close election. So it's going to be harder for investors to do anything decisive without actually knowing what the outcome might be. But with that said, history would suggest, and I've got some data on this, is that over the last 50 to 60 years, especially when there's a change in party. So let's just say, for example, if it should go from Republican to Democrat, the notion that we would have a significant and sustained drop in the stock market is just probably not true. I think that there's probably merit to some correction. That correction may take place leading up to the election, not before it, because it stands to reason based on current policies that have been suggested, some very favorable things that are currently in place for public companies, including a reduced corporate tax rate, reduced regulation. You could probably see that pulled back the other way, say, should Biden win the election. And if that happens, I do believe that people are going to accelerate some profit taking in 2020. It's just hard to tell when. If it appears that the election is, as current polls are suggesting, that maybe leading into the fall, if it appears that there's going to be a change is imminent, and a few of the questions that I've received are implying that that might be the case, then I think that the profit taking could happen sooner than later. Again, where do the profits go? So what we're trying to anticipate is if equities are trimmed, there's certainly not a strong argument to be made that cash and bonds and the policies that are currently placed don't incentivize many dollars to go to cash and bonds. So it still, again, could make our participation in the equity markets in different segments of it a favorable rotation, even with some election changes to the market.
So on that, Mark, if Biden does win, what changes do you anticipate making to the portfolio?
That's a tough question, Gary, because his policies, he's laying out his policies. I think he came out with more this week. There's definitely going to be tax increases if he can get them through Congress. He's proposed eliminating the tax cuts that the Trump administration put through. He's talked about raising the corporate rate that is now 21% back up to 28%. I would assume that the capital gains rate, which is currently 15% federal, would be in play. He's talked about, one of the Trump policies was to deregulate as much as they can to kind of free up the private sector to do their thing. I think that would be affected. And to be honest with you, we need to spend more time thinking through specific industries and sectors and how that would be affected based on that. I think we'll see some action play out in the markets in the months to come as the polls get tighter or wider, and as more policies come out. So I hate to punt on that, but I have to punt on that one.
So, and one thing I'll add, Mark, is we were just talking about this a few days ago, Gary. Back in March, when the markets fell so quickly, and we had a number of clients. We communicated with every client in the firm, and one of the things that we did very proactively and very aggressively is we tax loss harvested. And for those that might not understand what that means, we had the opportunity with a falling market to take positions that were at a loss. We sold those positions, and then we either laterally moved them into a similar investment or maintain the mix in some other way. So we participated in the rebound, but we have a lot of losses that from a tax standpoint, it gives us a ton of flexibility that as we get into the second half of the year, if we see opportunities to trim or take profit, and whether it's election based or some other data that comes our way that we think justifies trimming equity positions, at least it gives us a ton of flexibility to be able to do that. And so I'm not glad that we had the losses to take, but it was prudent to take them, and our clients will certainly benefit come tax time next year for sure.
Absolutely. So, how about, are you guys up for a rapid fire?
Rapid fire.
Rapid fire questions.
Sure, but I see a couple client questions, and I wasn't new technology, right? So one client question came in. What are your thoughts regarding negative interest rates, and how would this affect the portfolio allocation? And a second text from a different client came in about please be a bit more specific on actually addressing income, and when do you plan to reduce current fixed income bonds? Let me just take a shot. I personally do not anticipate negative interest rates. We had a senior fixed income strategist come in and talk to us several months ago and explain how the U.S. has been managing interest rates to the degree they have, and they are at extremely low levels. Talking to them in comparison to some of the sovereign nations that have actually gone negative. And we take a look at, even with the economic conditions today, I do not anticipate a negative interest rate environment. Could it happen? I suppose. There's not a playbook for that in the United States. We did recently modify the fixed income portfolio quite a bit here with an eye on safety, but also to be opportunistic. We added a position, and Mark, would you like to elaborate a little bit on the position that we added to the fixed income portfolio?
Well, the one we added is an investment grade bond fund. It's a little more on the active side. So if there were negative interest rates, okay, they would be able to position the portfolio to take advantage of it. Really, when it comes to bonds, you have there's two components: credit quality, and then the duration, meaning the average maturity of the portfolio. And what this particular manager does is they're looking at, and I won't get too wonky, they're looking at the yield curve and looking for areas where it's steepest, meaning there's more opportunity. For example, say the 1 year treasury or 1 year bond fund, the 1 year maturity was yielding 1%, and the 2 year was yielding 1.3. Versus, so the steepness means you get more return for the risk you're taking. And so they have the ability to position the portfolio where there's opportunity. I can show you on a board what I'm talking about. It's kind of hard to describe, verbally. But we felt it was we need to be more proactive and get a little more active on the bond side because it is very tricky. So that's one thing. We took a fairly large position, and I think I haven't checked in the last couple of days, but I think it's up 8%, 8-9% since we bought it. So that's a good start. On the other thing, the other question about specific income plans, I would prefer, and this is to you, Rick. I can give you very specific, like which exact investments that we're looking at, but I think it's probably better to do offline. And if there is an interest, we can maybe do another one of these or a write up as to exactly what we're looking at. So that we can address it because I think it's a very important question. One of the things that we're haven't determined yet is if we are repositioning some bonds or we're buying some higher income type securities. Do we take the money from the bond part or do we take it from the stocks? Like if you're going to add dividend stocks, do we increase our stocks overall to add the dividend stocks, or do we reduce our bonds? So there's a lot of different questions of where the money comes from, how do we allocate it, and how much do we put into it? And so we're still sorting through all the specifics around that, but we are actively taking a look at that. And as soon as we have fine-tuned that, we will certainly communicate that.
Here's another question that somebody had put in the chat is, what do you see happening in the real estate market?
I'll address that, at least with the current environment. A lot of our clients that own property are asking that question. I think it's difficult, again, the duration of the pandemic and what that's doing to small business and employers and owners of commercial real estate. That's a very significant question. That's another key component of income for a lot of our clients that are trying to contemplate what life would look like with either reduced income or a gap in income. So on the commercial side, I have a genuine concern about the commercial market. I don't know that it's permanent, but I think over the next 6 to 12 months, as we work our way through this, a lot of businesses are going to be closed, a lot of rent payments are not going to be made, and it's going to be tough for all parties involved. I think that's a very legitimate concern. Residential real estate market continues to thrive, kind of surprising on some level to me. But then again, if you take a look at how cheap money is and how ridiculously low mortgages are, the low mortgage rates are what has helped certainly sustain home prices, at least out here. So buyer demand has not necessarily stalled for home purchasing on at least in a lot of the areas in Orange County.
It's just a couple additional thoughts. I do think that residential real estate should be, barring, again, some unforeseen circumstances, continue to be strong because you have to keep in mind, you have to play demographics. We have the baby boomers that are retiring, huge demographical, population. And you also have the millennials, which are now in their 30s. And they are now starting to form families. They're now starting to buy houses. They were not buying houses. They didn't want to be tied down. They were having families much later. They are now buying. And so houses in Orange County, Southern California that are under, let's just say 800,000 are just, still multiple offers. So I think that's going to continue to be strong. I've talked with a lot of business owners over the last couple months, and I really do think there is a shifting landscape in work environments. Office is going to be challenging as a lot of companies, I'd say even most companies, are saying, I can't believe how productive we are working at home, and they're rethinking how much space do they need. Now, on the other side, this week, I did meet with a dozen other business owners where they're starting to see some fatigue on the work at home people. They're super productive, but now maybe they're not as productive.
Yeah.
So
almost like the drug has worn off.
Yeah. Well, and I think also the COVID haze, fog has worn off, where some people are, not as productive, and that's going to play out. So it's most certainly going to affect office. I think retail obviously is going to be affected because of all the troubles with the restaurants, and I think it's going to continue to be with these recent closures, even more so.
So here's another question. If we get into inflationary environment, what strategy will be used to ensure investment returns keep up with inflation?
Who wants it? I'll say one thing that, our founder, Richard Crum, I'll never forget this. He always said it. He says, because people talk about inflation forever. They're always worried about inflation. He said, I pray for inflation. That would be the best thing in the entire world if we see inflation, because that means we're growing as a country and an economy. And also you have the ability to lock in higher interest rates. Imagine if you had, a 30-year bond from the, 90s, well, I guess a 50-year bond from the 80s still paying 15%, what that would be worth right now.
Right.
So there's other investments, that, you have to be worried. You have to be careful about the short-term bond rates, because they will get hit. We do have gold in our retirement portfolios as a hedge against that as well. And there's other alternative investments that will do well in that environment: commodities, managed futures, and things like that.
Okay, so to rapid fire.
Let's go.
What are your clients most concerned about? John, we'll start with you.
I would say life returning to normal.
Okay. Mark?
What are they most concerned with? I don't know. I think I've had a lot of interesting conversations over the last several months. It's not necessarily, it's concerned about the election and the polarization of our country, and the fact that no one can talk to anybody on the other side of the aisle. And it's the cancel culture. All of those things are the most troublesome. From an investment standpoint, I think people are worried, but in the COVID thing, but they do know everybody's in the same situation. Everybody has sacrificed. Everybody has canceled vacations. I have a daughter who was a senior in high school this year that gets to do her graduation in a 2-minute walk through the parking lot, photo op, parking lot, in the car, out of there. And that's, and then you got the kids going to school. So it's more societal things necessarily than investment things. Just recently, I think people are always worried about investment markets and the future of that within this context.
Okay, second question. What single event will turn the economy around? Mark, we'll start with you on this one.
Vaccine.
John?
Is this like Family Feud where I can't say the same answer?
No, you can say the same answer.
I do believe, I call it global health confidence, either through a vaccine or therapeutics that allow people to have confidence to resume to normal activity.
How have your personal investments performed so far this year? John?
Same as my clients. And one of the things we do here, we use the same investments that we recommend for our clients. So I was down in March and stayed the course, and we're, it depended on allocation, because not everybody's allocation is exactly the same as mine, but by and large, most of our clients are about break even or near it. Yeah.
Same answer, Mark?
Same here. Yeah. I used to do my own thing, and realized that I was underperforming clients. And then about 10 years ago, I did my clients thing.
Right. So, good call.
It worked out well.
Okay, next question. What is your number one investment tip right now? Mark?
My number one investment tip. Well, it depends if it's short-term or long-term. Short-term, again, I really don't know, because it's certainly not Tesla stock, or maybe it is, I don't know. Long-term, there is talking about a disconnect in the markets, is we've seen a phenomenon that is very, very rare over the last 5 and 10 years, and that is the outperformance of growth companies, large cap growth primarily. Because historically, non-growth companies, or we'll call it value companies, have higher returns. They outperform over most time periods. They outperform 80% plus of the time, and they have underperformed by the most. I don't know if it's on record or if it's at least the last 50 years. So when that rotation goes out of growth, it's going to go significantly into these undervalued stocks. I think the outperformance is going to be breathtaking. I also do think that long-term, this is my number one, is I think emerging markets stocks, because emerging markets have been kicked in the teeth over the last 10, 15 years, and they have the best growth opportunities. They have the best demographics. They have the youngest populations. Places like India, Brazil, to mention a few, I think are going to be really good long-term investments, as opposed to things like, Europe has terrible demographics. Japan has horrible demographics. They are not growing. Russia, same thing. So there's a lot of countries that are going to struggle in the future just because their birth rates or immigration rates have been so low.
John, same question. What is your number one investment tip right now?
I think is to resist being too conservative. It was understandable in March. There was a lot of emotion involved with what happened in the market, and it was a different circumstance. It was powerful. It was people worried about their loved ones and continue to be. But the notion that we would retreat out of markets together, that there were some phone calls to discourage that. It's not having a relatively conservative allocation. We determine that based on a client by client conversation. But my encouragement to clients is, exiting stocks completely actually sets up for a totally different type of risk. Going back to when the inflation kicks in, we're going to want to have a material component to stocks that allows for maybe not great income opportunity in the near term, but at least to participate in the growth that will stem from that. So don't be too conservative, and otherwise stay balanced.
Last rapid fire question. Angels or Dodgers?
Oh, well, I don't know who's listening, but as a lifelong Angel fan, I'll go Halos. But I would take a Dodger win this year, and hopefully they get the season in too.
Mark?
I'm going to say Lakers. No. We have some huge Dodger fans here, and so yeah, I know I'm a lifelong Angel fan too. Frustrated Angel fan recently.
Yeah. Okay, closing questions. First one is, how were you prepared for the pandemic market sell-off, and what would you have done differently? So, John, why don't you start that one out?
Saying we were prepared for a pandemic is not realistic, right? But I think that in hindsight, as we've reflected on this, I think as a firm, the way we manage money and how we have relationships with clients and we progress through the life cycle of how their investments are allocated, I truly am grateful that we were ahead of this, in so much as we had no idea what was coming. But as stock markets and retirement plans were fortified, and over the years, we have been taking profit and reducing allocations to equities just based on the risk return need for a long time, leading up to 2020. So a lot of our clients, although nobody likes it when the markets do what they did, we had a lot of insulation built in, and a lot of safety around protecting from the downside. We do that incredibly well here, and it's like Mark said, I could show you on a board just how powerful that is. But I would say we were actually preparing for a correction of significant magnitude. Of course, the circumstances are tremendously unfortunate. What would we have done differently? Might make an argument that, you know, the textbook might have suggested that a robotic rebalance or adding to equities when the markets were down as significantly as they were. You know, in hindsight, you can make an argument that that would have been a great call. But what we did do in lieu of that was based on the nature of what was happening. There was a tremendous amount of fear. And I know Mark knows what I'm talking about. We made a decision to get on the phone and call our clients and talk to them and collaborate with them and see how they were doing and kind of reassess, you know, that their willingness to take risk, which we actually include when we make decisions sometimes. And this time it seemed appropriate. So I wouldn't change that. You know, we might have left a little upside on the table, but I think for the betterment of knowing our clients in the depth that we do, it was the right call.
Mark?
Yeah, I agree with John. I think this downturn was different. I've seen quite a few of these downturns. This was, you know, we're seeing 13% declines in one day. I mean, there's probably 5 days where it's down 10% or more. And so we hopped on the phone with our clients and we said, hey, you know, we want to get in there and rebalance. And how do you feel about that? And I think pretty much every single client I talked to said, hey, let's just wait and see how this goes. This is a pandemic. I mean, this was different. And what ultimately happened is we had a V straight off the bottom, straight to the moon, without a pullback. And there was no chance. We haven't had a chance for the test of the lows again, the retest. It hasn't happened yet. I mean, we haven't even had, we've had maybe a 5% pullback at any point in the last 2 months. And so in hindsight, we would have said, not even ask the question, just did it, or, you know, but I think I think clients appreciated that we asked and that we were concerned about that. But I will tell you, 2018 December, we were robots during that 20% decline in December, and our software really did its thing, and we're proud of that. And also the tax loss harvesting that John mentioned earlier. I'll tell you, if I had to pay Doug, our trader, overtime, I mean, I can't even imagine how much he would have made, because that poor guy was tireless, working weekends, late at night, doing the tax loss harvesting. And the thing about tax loss harvesting is every loss that we raise, and again, we're not out of the market because we sell something and then buy something simultaneously, but every loss that we raise, I like to say, is the only guarantee we can give you as investors. We guarantee you can save 25% on the money that we raised in losses. 15% federal tax, and at least 15, and then 10% California tax. 25% that you will not pay for every dollar that we raised in losses. And so I'm very proud of that. And obviously, I think with any event, you always have to take a step back and evaluate, okay, what would we have done differently, which we have, and make changes to for the better.
And I mean, going through a pandemic, nobody's gone through a pandemic. Nobody knows what is going to be happening. So, excuse me. Last question, which is kind of not even a question in itself, but what is one question that you were not asked, but you wish you had been? John, let's start with you.
Mark just mentioned Doug, who is our trader and just did a phenomenal job. But I would always like to be asked, Mark and I have these client conversations, and we're kind of on the front lines, and we love this stuff. So we talk about it off camera all the time. But really, when it comes down to, we can articulate kind of thoughts and assumptions, and some of them may come true, some of them won't. But when it comes down to the execution, I always want to be asked about our team. Our team here really is poised, professional people that came together and Mark and I are managing client relationships, but behind the scenes, the execution on our ideas could not be performed without our team. So I always want to make sure, our team's good. Everybody, we're back to work with some new rules and stuff like that. But I always wish that people would ask about the team so I could have an opportunity to express my appreciation for them.
Nice. Mark?
I forgot to say, Doug, if you're watching this, you were the MVP of that downturn. So.
Oh, and Doug's a Dodger fan, by the way.
Oh. So Mark, same thing to you. What one question were you not asked that you wish you would have been?
Well, I think probably one of the most important questions is how am I going to be financially as a result of this downturn? And is this going to affect my retirement or my life in some financial or some significant financial way? And, thankfully, I think the answer is not much. And that's because, 5-10 years ago, we looked at the valuations of the stock market and looked at kind of future returns. And when we're doing planning, we look at all these hypotheticals, what do you spend? What is inflation? What are taxes going to be? What are investment returns? And the investment returns that we use in our planning were on the conservative side. So we use 5% on let's just say a 50% stock portfolio, when historically it earned 8%.
Right.
Okay. And we did that intentionally because we didn't want our clients' lives to be stressed if there was if there were returns that were stunted for some period of time. And so, I think we did the right thing, and that's my answer.
Good. Well, thank you guys, both of you, not only for providing your wisdom and knowledge, but also in regards to helping out clients understand sort of the methods that go into how you guys perform in regards to your portfolios. I know that I've personally got a lot out of it, and I hope that all of your clients did too. And if you are watching this and you have additional questions, please reach out. Mark and John are always here for you. And ours Crum would be more than happy to answer any and all questions for you. And for all of those that were asking questions either in the chat or also beforehand, thank you for contributing to this webinar, because without you guys, we would have had no questions. So, and again, Mark and John, thank you for your time and for being here for your clients. Really appreciate it.
Absolutely.
Thank you, Gary. Appreciate it.
Gary.
Thank you, everybody.
All right. Have a good one, guys.
Okay. All right. Thank you.